I am Neerav, the moderator for this conference. Welcome to the third quarter FY 2023 earnings conference call for Motilal Oswal Financial Services Limited. We have with us today Mr. Motilal Oswal, Managing Director, Mr. Naveen Agarwal, Director and CEO, AMC, Mr. Ajay Menon, CEO, Broking and Distribution, Mr. Shalibhadra Shah, Chief Financial Officer, and Mr. Chetan Parmar, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now invite Mr. Naveen Agarwal to make his opening remarks. Thank you, and over to you, sir.
Good afternoon, everybody. It is my pleasure to welcome you all once again to the Motilal Oswal Financial Services earnings call for the third quarter, ending on December 2022. I'll take you through the key highlights of the operational and the financial performance. The operating profit after tax for the 9 months was at 619 crores, up by 12% year-on-year, and was marginally lower for the quarter that we reported at 217 crores. Core businesses, starting with the capital market business, reported a profit after tax of 136 crores in the third quarter, up by 3% quarter-on-quarter. And for the 9-month period, reported a operating profit of 359 crores, which is up by 3% in terms of the 9-month period. The asset and wealth business reported a profit after tax of 669 million, 66.9 crores, and which is flat quarter-on-quarter. And for the 9-month period, reported a profit after tax of 1.92 billion, which is 7% lower than the same period last year. As far as the home finance business is concerned, we've seen strong traction there. We reported a profit after tax of 363 million, up by 9% quarter-on-quarter. And for the 9-month period, we reported a profit of just over 1 billion rupees, which is more than 2x of the profit in the same time last year. Our consolidated net worth stood at 6,230 crores. Our net debt stood at 6,330 crores. Excluding home finance, our net debt stands at 3,850 crores. Our debt equity is 1.5 times, and excluding the home finance business, the debt equity stands at 1 time. We declared an interim dividend of 7 rupees per share. I'll now take you through more details of individual businesses, starting with the capital market business, which comprises of retail broking and distribution, institutional equities, and investment banking business. Revenues for this segment were at 349 crores, up by 5% quarter-on-quarter, and at 2,069 crores, up by 12% for the 9-month period. Our profit grew by 2% quarter-on-quarter to 136 crores during the quarter, led by strong volume growth of 32% quarter-on-quarter. The volumes are substantially up on a year-on-year basis. We also saw an improvement in our retail F&O market share by over 50 basis points compared to the sequentially previous quarter. In the same quarter last year, there was IPO funding net interest income of 46.7 crores. If we were to exclude that, the profit after tax would have grown by 20% year-on-year. For the 9-month period, our profit after tax for this is at 359 crores, which is up by 3% year-on-year. We acquired a total of 511,000 clients in the retail broking and distribution business in the 9-month period, led by traction in our online channel. Our NSE active clients have registered a 14% year-on-year growth at 900,000 as of December 2022, and we rank in the top 10, rank 9 in terms of the active clients on NSE. 60% of the brokerage in this business comes from clients which are more than 2 years of vintage, showcasing the stickiness of the clients. The average payback period of the digital channel, which used to be in excess of 12 months earlier, has now come down to less than 6 months. And this channel has also contributed more in terms of the new client addition in the 9-month period. The distribution AUM is a tad short of 20,000 crores at 19,370 crores as of December, up by 17% year-on-year. and the net sales for this business is at 780 crores in a 9-month period. We have a very strong 53 lakh client base, which is also growing, and that provides a very strong funnel for cross-selling of ABS financial products in the coming quarters and years. Our interest income for the quarter was at 211 crores, up by 27% quarter-on-quarter, led by a 14% growth in the margin trading book at 3,320 crores. Our currency market share stands at 15%, up meaningfully quarter-on-quarter, and our commodities market share stands at a tad below 7%. During the quarter, we launched the Option Store Pro for advanced traders with features to create customized strategies. Given the large, predominantly options-led market, we believe that this offering should further help us boost our market share. As far as the institutional equities team is concerned, they once again saw strong rankings in the Asia Money Brokers Poll 2022, and specifically we ranked number 1 corporate access team and number 2 sales team and execution team. The investment banking business completed 3 transactions of a raise of 2,330 crores during the 9-month period, and we are hopeful of traction in the fourth quarter as well as the coming year. Turning to the asset and wealth management business, the total assets under management across the asset management, wealth management, and the private equity business are a tad short of 1 lakh crores at 97,300 crores, and the net yield across these assets during the 9-month period averaged at 74 basis points. The asset management business AUM was flat quarter-on-quarter at 46,500 crores. The mutual fund AUM grew by a small proportion in the quarter at 29,500 crores. We have witnessed improvement in the performances of several schemes. A lot of them are in the top quartile or the second quartile, and we believe that this in turn should reflect in terms of the traction. We've already seen the negative net sales numbers come down by a third on a year-on-year basis, from over 600 crores to around 200 crores, and we think that this should hopefully turn positive in the coming quarters. The revenues for the third quarter for this business stood at 141 crores, and for the 9 months stood at 424 crores. We added 67,000 new SIPs in the third quarter, with traction witnessed in the active funds, which saw SIP count addition growth of almost 20% plus during the current quarter. Our private equity business has a fee earning AUM of 9,540 crores across our private equity and real estate funds in all 7 of them. In the third quarter, the revenues for this business stood at about 51 crores, which is a very strong 57% growth, and in the 9 months stood at 122 crores, which is a strong growth of 46%. The wealth management business AUM stood at 41,300 crores as of December, up by over 20% year-on-year. The wealth business revenues at 578 million in the third quarter was up by 13% quarter-on-quarter and 7% year-on-year, grew to 156.3 crore rupees. We garnered net sales of 4,560 crores during the 9-month period. Our RM count increased as of December by 20% year-on-year from 139 to 166, and that in turn is responsible also for a meaningful increase in the employee cost and the operating expenditure of this business. In addition, we've also bolstered the leadership team with senior management hiring to strengthen the ultra HNI offering and our advisory capability. All of this has led to lower operating profit margins for this business. Although we plan to continue to invest in this business by adding more relationship managers in the coming quarters and years. Overall, the asset and wealth management business revenues stood at 250 crores, up by 7% quarter-on-quarter. For the 9-month period, stood at 702 crores, up by 3% compared to the same period last year. Profits were at 66.9 crores for the quarter and 191.6 crores for the 9-month period. Turning to the home finance business, the home finance business reported a profit after tax of 36.3 crores during the quarter and 101.8 crores during the 9-month period, both very strong growth rates compared to the low base led by provisions in the last year. Our NII grew by 10% year-on-year. NIMs expanded by 66 basis points YOY to reach 7.8% for the 9-month period. Our yield on advances in the 9-month period stood at 13.8%. Our cost of funds went down by 40 basis points because of the full benefit of the rating upgrade to 7.9%, resulting in an expansion of spreads to 5.9%, which is an increase of 34 basis points. Our RPLR increased by 50 basis points with effect from 1st of January 2023, and we expect impact of this to show up in the fourth quarter of the year. Disbursements at 640 crores for the 9-month period are up by nearly 50% compared to the same period last year. Although this is still very tiny in the context of the sizes that we've achieved in the past, and we believe that the business is geared for a very strong disbursement growth in the next year compared to the base of the current year. Our gross NPA stood at 2% as of December 2022. Collection efficiency was 100% during the quarter. We had guided that nearly a fourth of our restructured book could slip, and that is the reason why the gross NPAs are at 2% marginally higher in the current quarter. Our gearing stands at 2.2 times. Our Tier 1 capital adequacy remains robust at 45%. And so, from a capital perspective, the headroom to grow this AUM meaningfully in the next year and in the coming years exists. Turning to our fund-based businesses, this includes the sponsor commitments to our various funds in the public markets asset management business, in our private equity funds and our real estate funds. The total investments, including unrealized gain as of December 22, stood at 4,720 crores. The investments, including alternate funds, stand at 4,320 crores as of December 22 equity investments, and the XIRR on these investments stand at almost 20% as far as the PERE business is concerned. The overall XIRR of all these investments that we made till date since inception stands at about 17%. To conclude, we have delivered a reasonable performance in the third quarter despite the market headwind. Our retail broking business continues to improve its market share through digital initiatives and also is benefiting from meaningful market expansion and industry consolidation. Our asset management business, as I mentioned earlier, have seen improvement in performances of the various mutual fund products, which ran quartile 1 and 2, and is looking to improve market share and net sales in the coming quarters. Our home finance business has seen strong turnaround in profitability, and this should follow a meaningful growth in our disbursement and AUM in the coming year. All in all, we remain optimistic on the opportunities offered by all our businesses. Thank you very much, and we are now open to question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah, hi. Good afternoon, sir, and thanks for the opportunity. So, my question is on the broking business first. So, we have gained a little bit of market share, which is quite good. But we just wanted to understand the impact of, the new ruling on the potential income, interest income that we have, and also the strategy going ahead in terms of whether we will focus more on market share or yields, and how will the overall revenue pan out, considering that in this quarter we have gained market share, but the yields have gone down. So that is my first question on the broking.
Hello?
Yes.
Yes, sir, you are.
Hello?
Yes, sir, you're audible.
Yeah. So, in terms of the market share, it's really a point about the F&O market becoming bigger, and we wanted to participate in that. We have come out with specific products to align the growth strategy towards the futures and options. And we see that being built up in the times to come with more of digital strategies. As far as the yield is concerned, it has come down a bit, but I don't think in the overall scheme of things, our yields are still much better than what the industry average is. So in that way, we feel that the expansion can continue in the model which we are, where we have the phygital model of advisory along with the digital prowess. Coming to the point about the funds blocking, I think which consultation paper has come from SEBI. I think there are a lot of regulations which has come in the last 2 years. We have gone through it, and we have only seen overall impact being positive in the overall market. So going forward, we'll see the impact as it comes. But I think at the end of the day, there will surely be some impact when the funds are moving from the bank account of the customers. But in the overall scheme of things, it will only help in improving the overall market from an overall perspective.
Okay, got it. And the second question is on wealth management, in the sense that we have increased our RM, and that should lead to the AUM growth and subsequent revenue growth, but the costs have also increased. So could you just let us understand the profitability in this segment when it is expected to pick up?
Participants, please stay connected. Line for the management dropped. Ladies and gentlemen, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. Sir, you may go ahead.
Yeah, go ahead, Vishal.
So I can repeat the question. The question was on the wealth management. So, there is obviously there will be an increase in revenue with AUM growth and RM growth, and there is also cost incidence. The balance of which, in terms of profits, when you see, we can see a profitability improving gradually.
See, as you've seen, we've added to the leadership team meaningfully this year. That is not a recurring. That is not likely to recur in terms of increases once again next year, and we should get the benefit in the coming year. However, the RM addition count of 20% increase that you've seen to 166 numbers is something that we plan to continue to keep growing in the coming year as well. So to that extent, you will see those investments continuing. However, given the strong growth in the RM base that we've seen in the last 2-3 years, that as the vintage of the RMs improve, they start contributing profits from the year 3. So at least the old RMs that we've added in the last 3 years should contribute to improved profitability. But as of now, the limited point that we would like to make is that we'd like to continue to increase this relationship manager base strongly, at least in the next 2 years, and and in turn grow the AUM of the business very strongly. So that will be the primary focus of this business.
Yeah. So I just want to understand that, at some point the plus minus would lead to a net addition in earnings, right? So what I'm trying to say can that happen in next year?
I'm not very sure about that at this point. We would be focusing on continuing to grow the RM base even in the next 2-3 quarters. So I don't see the benefit of that coming even in the next year.
Understand.
Possibly in the year after that you start seeing the operating leverage or the benefit of all of this.
Understand. I'll get back in the queue for follow-up questions.
Sure. Thanks, Anshuman.
Thank you.
Thank you. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi. Good afternoon, everyone. Am I audible?
Yeah, you're audible.
Hi. So firstly, can you quantify the idle customer funds in the broking business for Q3 to understand the impact if ASBA block trade for secondary markets were to come?
So this number would be to the tune of around 3 to 3,500 crore.
And we would be earning close to about 5.5% annualized yield on this, right?
Yes.
Right. And so on this, again on this ASBA block trade regulation paper which is floating around. So what is your sense? What could be the potential implementation challenges? Firstly, for the industry and for the small brokers, would it mean that they'll have to incur much additional cost to bring their tech up to the mark to have these kind of trades possible for their customers? Some color around that.
So there's surely going to be a lot of process requirements, and I think the associations like me and others are even talking to SEBI regarding the implementation challenges. And at the same time, the consultation paper talks about it being optional to start off with. I also feel there is a UPI limitations of around 5 lakhs. Up to 5 lakhs is the limit per customer. So again, the retail customer can be done, but what about the HNI and the bigger customers? So there will be challenges as we go by it, but I think it's going to be a slow process of how it gets implemented and how the industry takes it from there.
Right. So do you expect, so if this regulation were to come, do you expect further consolidation in the industry from top 10 brokers gaining market share from these small brokers, or given that it would be optional, we don't anticipate much of consolidation on this?
I think overall from the digital strategy, the way the business is moving, it is always a time that the consolidation will happen. So all these changes which have happened in the last 2-3 years, there is a consolidation which is seen in the industry, and this is only going to continue. So I surely see that the consolidation can happen within the smaller brokers getting marginalized. And at our end also, in our franchisee business, which is one of the biggest business, we have been able to convert a few of the smaller brokers as our franchisees as a strategy.
Thank you. So the line for the participant dropped. We move on to the next participant. The next question is from the line of Deepak Sonawne from Haitong Securities. Please go ahead.
Yeah, hello sir. Am I audible?
Yeah, you're audible.
Yeah. Thank you for the opportunity. So I have a couple of questions. The first few are on broking. So currently we have around 7,690 franchises, right, as of December 22. So just wanted to understand, out of our 33.6 lakh gross client base, retail client base, how much percentage is contributed by the franchisee?
It's around 50% of the base.
50% of the base. And again, within active client base of 9 lakh, will it be same?
Yeah, it will be around the same thing.
Okay. Sir, on your introduction call, you mentioned that the payback period for retail and the clients being acquired through digital channel has lowered significantly to 6 months as compared to 12 months a year back. So just wanted to understand, out of our broking revenue, that is core brokerage revenue of around 437 crore in Q3, what will be the contribution from these digital customers, acquired through digital channels?
That number will be around 15%.
15%. Okay. Thank you, sir. And my last question is on AMC side. So if you can provide us, gross and net sales for AMC in Q3 and against in 9 months as well, that will be really helpful.
For the third quarter, the gross sales is about 1,700 crores, and the net sales is a redemption of about 800 crores. For the 9-month period, my team will separately, give you these numbers also.
Okay. Yeah.
Thank you. The next question is from the line of Vishal from ICICI Securities. Please go ahead.
Hi, thanks for the opportunity. I had 2-3 questions.
Vishal, sorry to interrupt you. May I request you to speak a little louder, please?
Hello, am I audible?
Yes, go ahead.
So I just wanted to understand 2-3 things in HFC. First, I wanted to understand the growth. So disbursements in this quarter have gone down and resulting in a very, around 1% growth in AUM. Just wanted to understand the disbursement growth part and that resulting in AUM growth for the next year as well. That is the first thing that I wanted to understand in HFC.
So as far as the disbursement quarter-on-quarter is concerned, is because of the lower disbursement on the construction finance pool overall. So that is slightly lumpier. That is why you see some movement in the disbursement. But overall, the disbursement run rate is almost last full year's disbursement we have achieved in the first 9 months of the current financial year. And we expect a stronger disbursement run rate in quarter 4 and the coming periods as highlighted earlier in the call. In terms of the PMAY number, so overall AUM is also reduced because of the PMAY subsidy which has come up, because we received almost 3% subsidy which has reduced our overall assets under management.
Okay. Understood. So should we expect like a good growth, AUM growth number for the next year? If disbursements are going to be good?
Yeah, so as we are looking to hire more team on the sales side and enhance even the productivity of the existing team, we believe the disbursement run rate would result in a larger throughput of numbers on the retail disbursement front as well.
Also, in addition, you will see us adding to the leadership team, including the CEO at the home finance company. So as we make those announcements over the next 3 months' time, we think that we are in a, we should be in a good position to grow the disbursement as well as the AUM in the next year ending March 2024, compared to the year that is underway right now. So we're looking at a strong build-up. I highlighted in my opening remarks that our gearing is at 2.2, 2.3 times. We have cost of funds which are very competitive. We had a rating upgrade last year, benefit of which is coming through now. Spreads are very strong. The distribution network is over 100 branches already. We have about a tad under 500 feet on street, which we expect to take up meaningfully. So all of these initiatives combined with the leadership being in place should provide us very strong runway for growth over the next 2 to 3 years, including the next year ending March 24.
Understood. Thank you so much for that. The next part in HFC itself, I wanted to understand that the GNPA has gone up quarter on quarter, but credit cost has declined. So just wanted to understand the credit cost trajectory as well. And linked to the part that you said that you are looking to hire people in sales, so how should we think about the OPEX as well in HFC business?
On the GNPA front, the marginal slippage during the quarter is mainly on account of the restructured book. So as initially we had guided almost 25% of our restructured book could slip into the NPA. So out of that, partially there has been slippage in the current quarter, which has happened. However, we had adequately provided for the restructured book at an average rate of almost 13%. So the PCR still remains on the NPA book at 49%, and standard provisioning continues to be higher at almost 1.32% on the book. So marginally slippage has not resulted in any further increase in the PCR. It has only been maintained last year.
Okay. And on the OPEX front?
On the OPEX front, would continue to remain elevated because as we are further hiring, as informed in the last question, that we are further hiring at the senior level and even at the overall sales level. So OPEX would remain elevated overall, but because we have robust NIMs of almost 7.8% and our credit costs are now meaningfully lower in the business, we expect a good ROA moving forward in the business despite the elevated OPEX which would be in next couple of years.
Understood. My next question, I wanted to understand about the fund-based business. So your revenue in fund-based business has fallen very sharply in this quarter, which is also resulting in consolidated PAT falling sharply. Just wanted to understand how should we think about it for the Q4.
Yeah, this is actually on our investment that we have made largely into the equity assets, the book size of which is reported totally at 4,900 crores, out of which 4,300 crores is the equity asset base. In this book, because this book is subject to mark-to-market accounting, so every quarter basis the overall NAV of these funds, there will be movement in the profitability, which we report separately under the mark-to-market line item. So it's a function of actually equity market performance. That's how this book number on the P&L would move.
To add, we highlighted that the XIRR since inception cumulatively for this book stands at 17%. So without trying to look at it from a quarter-to-quarter basis, the management expectation is that we should be able to generate on this 4,900 crore book some returns in that vicinity of what we've delivered over the last, I think, 6 or 7 years. This is the XIRR over a 6 to 7 year period, and it is I think a good indicator of what one should expect even in the future. I think that is our expectation from the capital that is allocated to this business.
Okay, understood. Thanks. Just last question I had regarding PERE business. Just wanted to understand our fee earning AUM has increased quite a lot quarter on quarter without despite no new fund launches. I wanted to understand that, and also our yields have increased. So just wanted to understand that as well. Why has that happened, and how should we think about it going forward? And lastly, employee expenses have also increased in PERE business. So just wanted to understand this also.
Yeah. So on the PERE business, on the private equity side, we had actually the closing of our fourth equity growth fund. We closed the fund at 4,500 crores of commitments. That closing had happened in Q3 of this year, and that is why you see a slightly bump up of the revenues, because the final closing that happened would have impact of higher revenues of 1 year of fees, which would be taken from all the investors who came in the last close to make them at parity with the other investors. So that is the reason you see higher revenues which would on account of the final closing. And also we added the GIFT City entity which we had created few months back, and that was approved by RBI and made our wholly owned subsidiary in Q3 of this financial year. So by virtue of that, the revenues from that GIFT City entity also came in, which were out of the earlier close in this current quarter. So overall people cost provisioning has happened because of the added revenues as well. So from this quarter perspective, it would look higher because it has impact of the earlier quarter revenues also coming in the current quarter and associated people cost thereof. So that is the reason. Overall, however, in the business, the people cost to revenue ratios will be almost same as what in the last financial year.
Okay, understood. Thank you so much.
Thank you. Next question is from the line of Kajal Gandhi from ICICI Direct. Please go ahead.
Hello. Thank you for the opportunity, sir. So 2-3 questions. One is on everyone in the street is seeing decline in active clients. So how are we seeing that? We haven't seen too much because from September, October to now, it is marginally stable. So what are we looking there? Second thing, I wanted to ask, where certain brokers were mentioned that tier 2, 3, 4, like those levels also, the clients are giving equally good revenue, the newly acquired clients. So what is your take there?
Okay. So regarding the first question regarding the active client, mainly it is because we have been adding clients based on quality parameters with margins. So the entry point has been very clearly aligned with the quality which we want to get in. So to that extent, the attrition in the client is comparatively lesser, and that is how we have been able to ensure the active client base even in the last quarter. Coming to the tier 2, tier 3 cities, surely we are also getting clients from tier 2, tier 3 cities as in the overall scheme of things. But at the same time, I think for us, we have got a good distribution network across our franchisees and branches. So the mix might be much more towards the tier 1 and the metros to that extent. But acquisition is happening on tier 2, tier 3 as well.
Okay. So what is the cost of acquisition we are seeing? Any trend of lower, because that is what right now is happening because most of them have stopped extra expenses on advertising and all.
Cost of acquisition for us is 2,500 rupees. Yeah, and as we have highlighted that our break-even has also improved on the new incremental clients that we have acquired. So our break-even is now less than 6 months on the newly acquired clients.
Okay. And so one more question. You have not yet shifted to the flat broker in any of the products. So what is the sense you're getting in your clients? Because still you are able to see such a huge jump in your last 2 quarters F&O volume. So what is the trend there? Like, because even after flat brokerage, this surge is not seen across everywhere. So what is the call there or sense there that you're getting?
So, as you know, we have always been based our thing on research and advice, and where we have got advice for advisory support for each of our clientele. So the overall value proposition is based on the advisory and the research which we give, and we very clearly see that we will not be following the flat model. And as such, we have not seen much pressures on the yields. Surely the yields have come down a bit, but it is still far better than the flat brokers or the discount brokers, as you see. But the biggest value add is the research and advice, and along with that, the distribution network which we have aligned for a customer, so that he gets a holistic solution to us, whether it is broking or third-party products through our advisors.
But still, when we see your cash brokerage versus F&O brokerage, the F&O has gone up from 218,000 to 289,000 in sequential quarter. But accordingly, then on being on ad valorem, the revenue from F&O brokerage has not surged that much.
Yeah, so one is of course on a higher volume, our market share is also growing higher. So there is definitely some marginal impact on the yields which is there. So that is one of the reasons where the F&O revenues definitely will be marginally lower in the mix. Revenue gone up, revenue has gone up. The absolute revenue has surely gone up on the F&O side.
Okay. But yeah, in all, there is decline in cash, so that has got impacted on your total brokerage income.
Yeah, that is it. But even in quarter three, actually the overall number of trading days are also lesser and cash volumes have also come down. Look at both the parameters.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Abhijit from Kotak Securities. Please go ahead.
Hi, good afternoon. Few questions on the wealth management. If you can give some breakup of the recurring revenues between, let's say, what would be advisory driven and what would be commission driven as part of the recurring revenues.
We don't follow the advisory model, Abhijit.
Okay.
So it's all distribution revenues.
All right. And within the transaction business, just some major line items in terms of what drives revenues here on a recurring basis, on a quarter-to-quarter basis.
So the trail revenues nearly cover our entire cost is what we've been consistently indicating. Almost 80% of the operating expenditure that we reported this quarter is covered through the trail income.
No, I meant the transaction piece within the wealth revenues comprising 45%. Which are the major items that drive those revenues?
Yeah. So actually, alternate products are also driving the transaction revenue. So during the quarter, we had good sales of our alternate products, which has resulted in the upfront revenues mix.
Understood. And just generally on the wealth business, just broad thought process on what's the aspiration here from a 2-3 year point of view. What sort of a scale are you trying to build here? Any broad direction and size that you're aspiring for?
So this business is quite under-indexed for us in terms of total AUM compared to some of the leading players in the business. And so we are looking at improving our presence, including our relationship manager base. I mentioned in the opening remarks it's up by 20% year-on-year, December over December last year. We would like to continue to grow this. I think over the next 2-3 years, we would look at least doubling the RM base from the 166 odd number that we have right now. This is more indicative, directional. So that's the path that we are on, and that's why we've guided for elevated OPEX and cost to income ratios for this business.
And the target market would be somewhere close to where you are today, like around 10-15 odd crores sort of a segment?
We have been present in that category already. I again mentioned in my opening remarks that we've also got the leadership for the ultra HNI segment. So we would look at the same segment growth as well as adding to the segments and regions that we are present in.
Got it. This is useful. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Shalin Seth from Sears Fund Management. Please go ahead.
Hi, congratulations team. Congratulations on these great numbers and a very detailed presentation. My question is regarding to the advisory that we hold. We have close to 2,000 advisors and the average revenue given is about 7.7 lakhs. Just wanted to have a number as to what's the cost per advisor here?
We will not be having 5 lakhs. It's around 4.5-5 lakhs per advisor.
Okay, 4.5-5 lakhs. So this becomes a big amount in terms of our revenues. About 33% is coming from the advisor. So what exactly does this hold in terms of advice? Is it mutual fund distribution or pure brokerage?
It is mainly broking and not naturally the mutual funds and distribution, but broking is the big piece of the overall advisory.
It's a big piece. So in terms of our sourcing model, 47% is online and 33% is about the advisor. So Motilal itself the business is sourced through the advisors only mainly. Is that true?
Yeah. So the client has got the option to trade online as well as talk to the advisor. That is completely synced in, that whether he trades online or whether he does it through the advisor. So the customer has got the benefit of dealing the way he is prefers. Whereas the advisor is aligned to each client, so he can always give the advice to the client and the client can decide the execution perspective.
Okay, great. Thank you.
Thank you. Next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Hi. I have a few questions. I'll just sequentially put them so that it's easier for you to answer. Number one, on the yield on advances in your housing loan book, it remains at 13.8%, and you said there is a 50 bips rate increase you've taken. So the question I wanted to know is whether the customers are in a comfortable position to absorb that, and whether you'll see the yield higher in the next quarter, because even if you see year on year, I understand there'll be book changes and all, it's pretty much flat. So that's question number one. Question number two, how much of the book is still in the restructured category, and whether you're getting at least part payments? I can imagine there's a slippage to NPAs, but whether you're getting part payments from the clients given the fact that the macro environment seems to be good. The third question is on the broking business. If I see the interest income growth versus interest expense growth, quarter on quarter, because year on year again there'll be distortions due to the IPO. That you're seeing that the margins have compressed a lot. So are you, essentially not passing on costs in a desire to gain market share, or how does the dynamics work there? Thank you.
Yeah. Coming to the first question of restructured books. So overall, the restructured book stands at 251 crores on the total AUM of 3,660 crores. We have actually, on the interest rate front, our overall yield is at 13.8%. This does not include any impact of the RPLR increase of 50 basis. This effect has happened from 1st of January this financial year. And this overall, the collections in last 12 months have been very stable. So if you look at this whole trend of collections, and even in quarter 4 and the period to come, we expect that this RPLR impact would be passed on to the customers without any material impact on the overdue book. And as far as the what was the third question? Sorry, so broking interest yield is actually at 14% on the lending book that we earn. So that book is average of 3,200 crores during the quarter, on which we earned almost 14% cross yield.
Sir, my question was more in terms of ability to pass on the interest rate hikes, because the interest rates have gone up very sharply, especially in the CD end and so on of the market. So whether that is going to compress the NIMs temporarily till the cycle reverses again, since is there any ability to hike your interest charges to the clients?
Yeah, so actually NIMs have already compressed over last 2 quarters, because so while there has been an increase of almost 175 basis in the overall cost of funds in the current financial year, out of which almost half of that increase has been passed on to the customers, and half of that has been absorbed at this juncture in our NIMs. So still we continue with a healthy NIM of 5.8% on this overall book.
Sir, thank you very much, sir. That's it, and wish you good luck.
Thank you.
Thank you. Next question is from the line of Deepak Sonawane from Haitong Securities. Please go ahead.
Yeah, thank you for the follow-up, sir. So my first question is on HFC side. So if you see that within our AUM mix, the construction finance contributes around 13% as of December, but it was almost around 11% as of September. So there's a growth in terms of AUM in this piece. But if you see that as a ticket size wise, about 2.5 million ticket size, it only contributes around 3%, right? And what you mentioned in note as well, that you are lending to Cat A builders, right? So there should be a disbursal of very high ticket size, right? So am I missing any catch over here?
Sorry. The current retail disbursements are running at a very low rate, Deepak. And as I mentioned to you, we are looking at stepping this up. We've seen, I would say 2-year high monthly disbursement in the month of December, and we're looking to ramp this up in the in the March quarter. But from a quarter-to-quarter basis, the CF book, which is very small proportion, may have lumpy disbursements between quarters, and it will not be as smooth as the build-up of the retail disbursement.
But what is the average ticket size for us in the CF business? I mean,
average ticket size in the CF business is 30 crores.
30 crores.
In the presentation, we have not put out that. What we have put out is the only retail average ticket size.
Okay. Thank you. Thank you so much, sir.
Thank you. Next question is from the line of Prakash Kapadia from Ambit Portfolio. Please go ahead.
Yeah. Thanks for the opportunity. A couple of questions. On the mutual fund side, how much is passive as percentage of our AUM? And, recently they have been opening of international funds. So how is the, unit holders' interest? Are we seeing step up? Are we seeing lump sum investments? Are we seeing new SIPs coming in? Because I think from January we opened the investing for global funds.
Yeah. So the passive AUM is about 20% of our overall AUM. And because of the reopening from January, we are seeing even some of the stocked SIPs have also started, renewing those SIPs or investing once again. But it's only early days. It's been only a few weeks. We wait for how this, quarter shapes up. Anyways, this is not a unlimited opening up. It is only to the tune of the, redemptions that these funds have seen that you have the headroom. So I think the real growth in this, I think the offshore side will only happen, Prakash, once, the overall limit is increased. Right now, even if this were to grow, it will not be very sizable.
Okay. So it's okay. That amount got reduced. Only to that amount it can come back. And once that comes back, again the SIP as well as the lump sum would stop.
Yes.
Assuming there is no limit change.
Yes.
Okay. Secondly, on the FI side, what is the sense we are getting from our client interaction? They've been net sellers in India in CY22, and given where we are seeing debt returns as of now, do we think retail flows or new investors who've just entered could stop SIPs or flows could get affected because markets have been challenging last 12 to 15 months? Any sense broader you can
see? Again, on a year-to-year basis, if you see last 20 years, most of the years foreign FIs have been net investors in India. Their holding over a longer period has gone up meaningfully. On a year-to-year basis, there are various factors that may, it could be overall redemption in emerging markets. Now, in the near term, it could be China opening up and a lot more money going there. So near term is very noisy and very volatile. But if you look at the growth of India versus the rest of the world, the earnings growth of India versus the rest of the world, the share of market cap of India in the rest of the world, and the holdings of foreigners in their overall portfolio of India, we are quite underrepresented. So the possibility that the flows will continue to be positive longer term is high. As far as the foreign investors are concerned. As far as the domestic investors are concerned, again, we've seen lesser volatility than we've seen ever before in terms of volatile markets versus volatility in the domestic flows. I think the SIP book has been reasonably strong and steady, notwithstanding what is happening to the FI flows. And that has a good counterbalance, at least in the last few years, to the direction of the FI flows. So I think structurally we see both of them actually at some point turning positive. Although in the last year we've seen the large selling offset by the large FI selling offset by the large domestic buying. So near term could be noisy, but longer term you would expect both these flows to be positive for India.
Sure. Sure, Naveen, that's helpful. And lastly, if I look at capital market related revenues, they are approximately two-thirds for us on a run rate basis as of now. Any direction or aspiration over the next 2-3 years? What would we want to have this as percentage of our revenues?
I mean, while growing the capital market side of the revenue for sure, given that market is consolidating, we spoke about that because of compliances, research, distribution, brand, a variety of reasons. We think that the capital market business itself has a lot of headroom. But having said that, we are investing, building in the wealth management business, in the home finance business. I talked about the asset management business performances, picking up. We spoke about the 4,500 crore private equity fourth series that we closed. We are waiting SEBI's approval for our next real estate fund launch, which will be 1,500 crores of AUM that will be mobilized. So we are really putting in all the building blocks in the rest of the businesses so that we can see faster growth in those businesses compared to the capital market business. As a first stop, you can look at a 50-50 breakdown, in the foreseeable future. But obviously, given the annuity nature of these businesses, they have a lot of headroom or a lot of potential in our view.
Okay. And in this era of consolidation, will pricing improve on the broking side, or with some of these new age brokers who've garnered more than 50-55% of active client share, pricing could remain muted or upward pricing could be difficult?
I think with the ASBA coming into picture, there might be some pressures in the discount brokers to look at the overall yields. But as far as we are concerned, we are still very much ahead of the discount brokers in terms of the overall yield. So we don't see any pricing going up from our end, but not sure about the industry on an overall basis, looking at the overall discount brokers in the overall scheme of things.
Understood. Thank you.
Thank you very much. I now hand the conference over to Mr. Shalibhadra Shah for closing comments.
On behalf of Motilal Oswal Financial Services, I would like to thank every investor participant to attend the Q3 FY23. In case if you have any further questions, please do get in touch with us. Thank you. Have a good day.
Thank you very much. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.